everybody, and welcome to At the Forefront Fintech Conversations. I'm Michael Kingsley. I'm a Senior Vice President at Forefront Communications. And Forefront is a strategic communications, marketing, and PR firm to the capital markets and institutional fintech sectors. And today I'm speaking with Aaron Hantman, who is the CEO and one of the founding partners of Tourmaline Partners, which is the leading independent outsourced trading solutions firm. How are you today, Aaron?
I'm doing well. Thank you, Michael. And thank you for inviting me to have the conversation.
Great, thanks. No, we hope it's going to be fun. And so what we're talking about today is a new report from Coalition Greenwich that came out about outsourced trading, a deeper dive into the outsourced trading evolution, it's called. Aaron, do you want to talk about what this means now? And actually, Greenwich took a look at outsourced trading 4 years ago, and this is sort of a different look. Can you tell us about that?
Sure, and I think that context of the first report is important. Although only 4 years ago, back in 2018, it was a look at what was happening in the outsource space. It had taken on a new level of attention. Outsource trading had been around for nearly a decade prior to that, but with only a very few players. And it was sort of becoming a topic of interest at the time. The original report asked sort of what it was, how people were using it, and if they were considering using it going forward. Just 4 short years later, we now have over 40 players or so in the community. There's been a really explosive growth in the use of the term outsourced trading and outsourcing in general across the investment community. So this report, this follow-on, is really, I think, a tool for the community to help navigate all of the different models and where we stand today. And that was what I think the attempt was.
Yeah, that's what I thought as well, that, you know, they lead with this big number about 400% growth in the number of the providers. And whereas the original report had a lot of questions like, you know, are you considering outsourced trading? Are you familiar with the terms and that sort of thing? This was a lot more focused on what the state of play is right now, and really spends a lot of time differentiating between the different models that are on offer now that the space has grown. So can you take us through the different models that are there? Obviously, you have a dog in the fight for sure,
Sure.
being one specific model, but take us through the way the report differentiates, what's on offer.
You know, I would say real briefly, there's 3 primary categories. Those that are considered the prime brokerage model, those that are independent, and I should clarify that Tourmaline falls within that independent category, and really a newer version that's evolved in those last 4 or 5 years, which is the custodial model. So in brief description, the prime brokerage model is derived by that prime brokerage relationship. It's typically oriented to clients that are emerging, hedge fund launches, with a single PB, and those PBs are handling the majority, if not all, of the trading for that particular client. They are a sell-side model and trade a bit differently than the independents and even differently from the custodians. In the independent model, you have a handful of firms that fall within that category, whereas in the prime brokerage model, I think they're the most populated version. So for the independents, they're operating without any of the other business lines that exist for the prime broker. So they're not producing fundamental research, they're not in investment banking, or really competing with any of those core sell-side businesses. That allows them to operate really as a buy-side trading desk, fully covered by the sell-side community. So today, Tourmaline is covered by over 400 sell-side broker dealers globally. And that puts us in a position, and the other independents, to bring order flow to the market in a true buy-side sense without any of the conflicts. The custodial model is primarily built around delivering front, middle, and back office solutions together. It's efficient for some clients that tend to be majority custody within that partnership, so that they can achieve those efficiencies. The trading platforms are quite different. All of the flow is internalized. It's almost entirely done electronically, as those desks are not covered in a high touch capacity by the sell side community in the way that the independents are. So it's well suited for very liquid names. I would not suggest that it's well suited for international or less liquid names. It's a different trading offering entirely.
Yeah, I think the report really goes through, and thank you for that in splitting out the three. And as we said in the introduction, you guys are the largest independent player that's there. And I'm curious, when you're talking to prospects, and well, I would say to you, what are the questions you think that a prospect for you, or just anybody who's looking for outsourced trading services considering it, what are the key questions they should be asking themselves to differentiate between those models, or to help them pick amongst those three models?
I think the most important thing that clients should focus on first is what their specific needs are. And that sounds quite simple and obvious, if you will, but I think many clients start from the position of learning and trying to decipher across those three different silos, and then within the silo, the differences between the firm. They should start with what their own needs are and how that can be best accomplished. So, if it's a hedge fund that has the needs to be paying many brokers or brokers outside of their PB realm, they will have different demands than somebody who's 100% electronic and has already established 5 or 6 different relationships that they are directing all of their flow to. So there's a complexity in it. I believe that the prime brokerage model is most appropriate for a single PB client. That's where there are a few other choices for those clients. They do need to remunerate their prime brokerage. Their trading commissions are a currency. In order to achieve that, it makes a lot of sense for both parties to keep that efficient. When they move into a dual PB, multi-PB, or a situation where paying other brokers is important, then the independent model is by far the clear choice. Operating in international markets should be reviewed too. Not all outsourced trading firms actually interface with brokers in these respective markets, and that becomes critical. Operational expertise is critical in international markets, derivatives markets, et cetera. That's another area where certain independents are going to excel in, where the prime brokers are going to struggle and the custodians are going to struggle even more. So if you look at where the custodial market shines, it's typically, as I said before, a long-only asset manager trading large cap, mega cap index names that can be done electronically and through only a few pathways of execution. They're not going to have extensive commission management programs that are going to support the payment of brokers outside of that custodial relationship.
And one thing we didn't talk about is, and I know it was part of your offering, the way you talk about it, is that it's not just full outsourcing. There's also supplemental trading, where you don't offload everything. Can you talk us through what the difference is there and how you guys sort of square that circle?
Sure. Supplemental trading, as you said, is a partial solution. It's an extension of existing trading resources at a client. That could be a single trader, could even be a portfolio manager that does a significant amount of trader. Well, alternatively, it could also be a global, sophisticated team of traders that are leveraging a position of a supplemental trader like Tourmaline for expertise, scale, pertinence with the sell side or within a certain market. The best example that I use is you can have a significantly sized hedge fund, $10 billion, that's a global investor, fairly common these days, right? They're trading billion or 2 billion or so notionally in a Asia markets or in a European markets. Whereas Tourmaline, we're going to trade $100 billion over the course of a year in those markets. We're going to do it with 75 brokers in Asia, 125 brokers in Europe, 10 traders on each team that are engaged with these brokers on a daily basis. That's hard to replicate even for a sizable hedge fund that's trading in a meaningful amount. They're just not going to match that same level of pertinence and therefore be able to deliver the same information, color, location of liquidity, et cetera. So at that point, the relationships becomes heavily driven, not just on the economic synergies, but on the performance factors that we are able to deliver. So the supplemental clients really fall within the independent silo only. If you wanted to supplement your trading with a sell side broker, one of the PBs, the first silos, you would have been able to do that for the last 3, 4, 5 decades. But you're not going to reach local liquidity and scale with a wide family or mosaic of brokers in those regions because you're represented by one.
Great. Well, listen, thank you for taking us through it. It's a really interesting report. We'd encourage anybody to check it out. This is the Coalition Greenwich report. I want to get the title exactly right. It's a deeper dive into the outsourced trading evolution. And you can download it from Tourmaline's website. You can also get it at Greenwich, but at Tourmaline's website, it's at tourmalinellc.com. You can also learn more about Tourmaline partners there. If you'd like to learn more about Forefront, you can visit us at forefrontcoms, that's COMMS.com. Aaron, thank you so much for everything today. We really appreciate the time, and thanks to everybody who's watching.
Thank you, Michael. Much appreciated.